it's a crucial question. And this is what financial education and financial literacy really is. Again, it starts with a financial statement. And I would say probably 95% of all college graduates don't know what a financial statement is. You took an accounting course, right?
Yeah, I did.
I know you did parts of this. But I say to young people like you, there's 6 basic words to financial literacy and financial education. And the 6 words, again, are income, expense, asset, liability. See, I don't really care about my FICO score. A FICO score just basically registers, are you trustworthy with borrowing money? But a bank will never say, I borrow in the hundreds of millions of dollars. A FICO score not going to get me there, okay? And so it's kind of a ruse. I mean, it's important, but not for me. So these are the 4 words, income, expense, asset, liability, and the last 2 words are the words cash flow. And that's why the game is called cash flow. And the secret to being rich is not a college education, but can you control cash flow? And this is what cash flowing looks like. So this here, I need this, income, expense, asset, liability. Again, this is, you get a job. And this was my poor dad, go to school, get a job, get your PhD. And so this here is cash flow. So the income comes in and it goes out this way. First line of expense is tax. So this is a poor person's cash flow pattern. It's not how much money you make. Most people, you know, I don't care if you have a PhD or no school at all, but they can't control the cash flowing out through their expenses. And so that's why people like Susie Orman say, cut up your credit cards, live below your means, because you're a spendaholic. So that's a poor person. This is a middle class person's cash flow pattern. And this is where the house comes in. First thing, you know, most kids do when they get pay raise and all that, they buy themselves a bigger house. Oh, my house is an asset. Now, who tells you that? Your real estate agent, of course.
Yeah.
Right? Because they want to give you this false sense of security while you're getting screwed.
Exactly.
You know, but when you look at what happens with a house, a personal residence, something I live in, the money comes in and goes out, and this is middle class, but it also goes out through a mortgage payments. Oh, but I don't have a mortgage. You still have taxes. You still, you know, Hawaii just raised the property taxes on me, which is probably what I'm going to sell. I'm going to get out of Hawaii. But you have taxes and you have upkeep. So money's always flowing out. So that's why your house is not an asset, is because it's taking money from your pocket. So very simply said, assets put money in my pocket, liabilities take money from my pocket. And then this here is, so I'm not saying don't buy a house, but here is a house. And I started when I was 25, bought my first house, and it was an apartment, it was an investment property. I didn't live in it, I rented it out, and it put money in my pocket. So very simple, the definition of asset and liability is not the house or this, it's cash flow. Where is the cash flowing? So as a young person, and to all millennials or if you're old, financial intelligence is the ability to control cash flow. And that's what they don't.
Hi, this is Cayden from VIA Value Investing Academy. Now, welcome to another episode of our Deep Dive series. But before that, I just want to make sure that all of you can hear me and see me, right? Let me just look at the chat. Now, if you are able to hear me and see me, is it okay? Just type 1 so that I know everything is fine. And what I'm going to do next, in the next couple of seconds, I'm just going to make sure that I share screen, right? Okay, so my slide is up. Click here, slide is up. And then I'm sharing screen. Yeah, sharing screen. Let me just click on my YouTube again. Okay, there are about 79 people. So Wendy, hi, nice to see you. Just to double check, are you able to see here? Everything is fine? Okay, good. I'm looking at my YouTube on my right side, maneuvering everything. Everything looks fine. So let's get started, right? But before I start, I just want to give credit to the producer of this video, which is the Rich Dad channel. Yeah, so let me just look at the channel again. Yeah, let me just circle, right, so that I give credit to this channel. Okay, you can see where my red pen is, the Rich Dad channel. So this video, I think, is about 4 years ago. But having said that, whether it's 4 years, 3 years, 2 years, I think whatever so-called Rich Dad, Poor Dad, Robert Kiyosaki say is still quite relevant. Now, if you are accountant or some finance trained person, you will think that what he said probably a bit nonsense. Yeah, but the key thing is I've read Rich Dad Poor Dad many years ago. I think the first couple of years when it was first published, it was so, how should I say, it was so counterintuitive. I was thinking, like what I've learned in school appears to be wrong, right? For example, when I was much younger, you know, me and my family, we stay in a HDB flat. And we have always been told that the house is an asset. Now, if you're an accountant, yeah, you know, you park under the balance sheet, right? So house, you know, is an asset, it's a long-term asset. Yeah. But from his perspective, it's from a layman, right? People like us, if you are an employee working in a company, but what is really an asset? So for us, we are not accountants, so it doesn't matter whether we park, how is it classified, how is it labeled. But as a layman, what it matters to us is we want something that gives us more money. Yeah, whatever it's called, you can call it X, Y, Z, doesn't really matter. Yeah, but of course, in this case, his perspective is in summary, right? In summary, anything that puts money in our pocket is an asset, and anything that takes money away from our pocket is a liability. Yep. So in his video, he shared about 6 keywords. You may notice that in this slide, there are only 4, right? So he said, you know, any layman, we need to understand 6 keywords. So in this slide that you see, the first keyword that we need to understand, right, is this word called income. I think everybody will know. Expense, everybody will know. So if we use our common sense, ideally, right, if we want to have more money, we want to increase our income and then decrease our expenses. Yeah. So there are some things on the bottom side that increase the income, some increase the expenses. So for example, in Singapore, there are quite a number of people who like to buy, let's say, condos, properties, and so on. So they want to rent out. And based on Robert Kiyosaki's classification, anything that puts money in the pocket is an asset. So in other words, if we have some form of income generating assets, then it increases further our income, right? Because we have a job, we have an income, generating assets further increase our income. And then, for example, if we own a car, yeah, assuming that it's not so necessary, but you want to show off, right? You know, I got this car and so on. So cars has a lot of expenses, road tax, you know, car park, all this stuff. So if you get yourself more liabilities, of course, the expenses is going to get more and more. Yeah, get more and more. So ideally, at least based on Robert Kiyosaki's definition, we want to have more income generating assets and we want to have less liability. And if we can do this, right, then our income will further go up, then our expenses will further reduce. And of course, our job is to accumulate this income generating assets, right? So now the question is, what are the type of income generating assets that we already know? So for example, let's say CPF. CPF, whether you like it or don't like it, as long as you work, you're supposed to contribute to CPF, right? So CPF contribute a range of 2.5% to 4%. So it does generate income. You don't really have to work for it, but the return is from 2.5 to 4. Yeah. So are there anything we can explore further, which is why it's important for us, for us to explore different ranges, right, of income generating assets. Sorry, I got a bit distracted because Yin Hao say, hi Kayden, nice to talk on the radio this morning. Okay, thanks. A bit distracted. Yeah, so this is the very first time that I met Robert Kiyosaki face to face. I mean, I have the book, but the book is different from the person, right? The context is I met him, let me recall, right now it's 2022. I think it's 2019. I think it's 2019 or 2018. Yeah, one of these years. Yeah, so the context is myself and this gentleman called Robert Kiyosaki plus Robert G. Allen, and these two are my friends. They're all Japanese, right? So all of us are involved in an event where there are 10,000 Japanese. Yeah, so it's like a huge Tokyo Dome. So let me just introduce a very quick introduction about who Robert Kiyosaki is, if you do not know. So the next picture showed the number of books that Robert Kiyosaki has written. Of course, the very first one that's a bit of life-changing for me, right, is this cash flow quadrant. And if I remove the yellow arrow a bit, you can see there is this EBSI. So I don't want to spoil the market. Yeah, if you want, you can always go and Google Robert Kiyosaki cash flow quadrant, and you will talk more about this. You don't really have to buy the book. So right now, just watch the YouTube video will do. Yeah, so this is a brief intro about Robert Kiyosaki. He's like the financial literacy guru. Not really investment guru, but like a financial literacy guru. So that is Robert Kiyosaki. Then there is this next gentleman, right? This one I think most people do not know. They're standing beside Robert Kiyosaki. This gentleman is called Robert G. Allen. Yeah. So again, in my much younger days, I bought books which are written by Robert Kiyosaki, and the other one is called Robert G. Allen. This one not many people know, but I'm going to pause this slide here for a short while, right? Now, these are the books that Robert G. Allen has written. I mean, coincidentally, both their names are called Roberts. Now, the very first book that I've bought, right, that was written by Robert G. Allen is this book called 1 Minute Millionaire. Yeah. So if you look at the title, 1 Minute Millionaire, I mean, it sounds quite scary, like 1 minute become a millionaire, right? Yeah. So I think the content of this book talks about how to change the mentality, the mindset. So in other words, if you can change your mindset within a minute, you actually gain the mindset of a millionaire. And I still remember in the early days when I bought this book, right, I actually finished reading an entire book. So I went back to my company. I was an employee then, and then I introduced this book to my colleague. So my colleague said something very sarcastic. He said, if I finish reading the book in 1 minute, will I become a millionaire? Yeah. So after he made that statement, I realized that I think our universe is a bit different. Yeah, because I aspire one day to become a millionaire, right? That was many years ago. But I realized that my colleagues do not belong to the category. They are just staying put and all this. So I realized that maybe one day I need to do something else. So that was a bit a trigger point. And then subsequently, of course, other than this book, I start reading other books. For example, this book is quite interesting. Robert Allen, right? Nothing Down. So in other words, how you can buy properties using other people's money and then not using your own money. And another one of my favorite is actually this multiple streams of income. Yeah, all these are really life-changing. Yeah, life-changing. So that is Robert G. Allen. And of course, just like I shared, right, the context where I met Robert G. Allen, you can see this face over here, right? Yeah, actually Robert Kiyosaki is here, but it's blocked by some infrastructure, right? And all this audience is really huge, you know. Yeah, it's really 10,000 people. Huge. It's like a Tokyo Dome. So this is me, and then, you know, I'm wearing this lanyard, so I'm more of a speaker. Yeah. So of course I'm not like them. I didn't write so many books. So far I've only written 4 books. 4 books, right? So I think the biggest impact they have on my mentality is I need to have some form of income generating assets that preferably that could beat the current high inflation. Yeah, so it's very simple, but it's a very huge, how should I say, a small flip, right, in the switch of our thinking about a huge shift in terms of my behavior. So I'm really thankful that I met 2 of them, Robert Kiyosaki and Robert G. Allen. And this photo was taken right after the seminar in a special VIP guest room. Yeah. So I think it's important for us to, how should I say, meet the right people. Yeah, you meet the wrong people, it brings you down the wrong path. So meeting the right people, I think it will bring us back not only the right path, but a brighter path. So this is quite important. So if I could put together a very simple slide, at least from what I've learned from Robert G. Allen and Robert Kiyosaki over the years, I could put it into a very nice flow, right, which looks something like this. So let's say this is Cayden, Cayden, right, many years ago, you know, graduated from National University of Singapore with a couple of degrees. So my thinking is, okay, if I study, so my role is to get something that I like. Yep. My degree is in zoology. I could work as a zoologist, and maybe this job will pay me some form of salary or some form of cash flow, right? Yeah, when I work as a zoologist. So in this case, it shows the cash flow, yeah, that was generated from the role, right, that I perform. So I do a job, I get paid. If I don't do a job, I don't get paid. Yeah. So let's say most of us, which is true, most of us, we really work, which is fine. So now the question is, if we have this salary, right? Yeah, the next question is, what do we do with this salary? Is the one that determines, are we heading towards the wealthier path, or are we heading towards the more struggling path? Yeah. So income comes in, and of course, under Singapore law, you got no choice, CPF. So that's one thing. So cash flow come in, and a portion of the cash flow, which is our employee CPF, goes straight to the CPF. Yep, go straight. Then, of course, whatever there's left, we may buy the latest iPhone 14, right? Yeah, which is the same as iPhone 13, 12, and so on. So you go and pay this, pay that, pay that. And then after that, you have maybe $500 left. Yeah, so some people may take this $500, leave it in the bank. And right now, banks' interest rate are highly competitive. In the early days, fixed deposit is about 0.05%. And right now, there are many banks, UOB, OCBC, our local banks, they're coming up with different gimmicks to try to tempt you to put your money inside. But of course, there's some criteria so that you can get higher interest. So be very careful, right, about this 4.88 because there are a lot of hidden requirements. So that's one way, yeah, for you to park your money, allocate money so that it generates income. Okay, income generating asset. And of course, the last deep dive, right? Yeah, mistaken CPF has raised interest rate. This one I'm not very sure. Last time I heard from the parliament, it doesn't seem to be so, because the CPF is under MOM Minister Tan See Leng. Increase interest rate. I don't think so, but we can double check. Maybe since there are 90 people of you watching, can some of you just Google and check whether the CPF interest rate goes up? Then you post in the chat. Let the rest know, right? Okay, let me just continue while some of you check. Yeah, then of course the last deep dive, which is I think about 1 week plus ago, Hillary specifically talked about this bond, right, called the SGS Bonds, which is Singapore Government Security Bonds. And in our autopilot or tri portfolio, we also talk about the Singapore saving bonds. So anyway, the range goes from 1.6 to about 4.8. Not bad, quite competitive. But the good thing about this 4.88, right, it doesn't have a lot of requirements like the bank. So in other words, if I want to get 4.88, I think out of the banks and these bonds, right, I would prefer to choose bonds. Except that bonds, sometimes you can get it, sometimes you cannot. Okay, so these bonds, right, are quite competitive, and it's another example of an income generating asset. But of course, some of you may argue, right, hey, Kayden, the core inflation is 5.1. Why do I want to put in 4.88? Now, I just want to let you know that you may think that you want to put in something that beats 5.1, right? But in whatever portfolio, income generating set of portfolio, you need to allocate a certain percentage to cash. So for example, in our 4 days value investing program, we said that about 25% you need to allocate to cash. So if it's allocated cash, you want to put in something that you can easily take out. Yeah, if you put in equities, it's not very safe. So you may want to consider, let's say, Singapore saving bonds where you can withdraw out and then there's no penalty. No penalty, right? So remember, some part of money you allocate to cash. Then another group is, for example, auntie, uncle. If my parents are still alive, if I tell them about S&P 500, I don't think they will do it. But if you tell them about Singapore saving bonds, maybe it's easier for me to convince them because I just need to say that, hey, this is protected by the government. Yeah. So if it's not for you, right, maybe it's for your parents, maybe your grandparents, or maybe for your relative who are not so educated. Yeah, where it's easier to convince them if you talk about something that's protected by the government. Yeah. So SG saving bonds, the Singapore saving bonds as well as SGS bonds that we spoke about it last week. So regardless of whatever instruments that we want to talk, there are still 2 key preparations for us to invest. First thing is we must know what to do. Yeah, and of course, we also need to know what not to do because some people just anyhow whack their cash, eventually end up losing money. Yeah, so of course, if you know what to do and you know what not to do, then if you have the cash to do it, that will be the ultimate. Yeah. So our job tonight for VIA, for me and Hillary, our job is really to provide the knowledge, to know how, yeah, which is very, very important because without the knowledge, we cannot make a very good decision. And in case you want to go back and then you want to visit our previous deep dive, right, which is our Singapore Government Securities Bonds, what you can do is there's a QR code that pops up right now. You can just scan, right? Just scan this QR code. Something pops out. Just do us a favor, right? Do us a favor by just clicking the subscribe button so that every time when there is any new research that we have done, such as this deep dive, you will auto be notified via your email. Yeah. So I'm going to leave this QR code here for a short while. Please ignore first CPF link. Is it? Yeah. So they did increase, is it? Oh, it's the same rate until December. Yeah. Yeah, I remember the Minister Tan See Leng in one of the parliament, he did say something like, no, we are not going to increase, something vaguely. Vaguely, right? So if you increase, I don't think so. But it's good. I think it's good that Wendy said so that we can clarify. That's why it's important for us to have a community, right? Yeah. So you all scan already the subscribe button. We still need subscribers, for our channel. We noticed that our competitors are catching up, so we desperately need subscribers. Yeah, for our vanity. Hell, is not subscribe. You all don't subscribe, I don't continue. I'm just kidding. Hey, by the way, before I start, is it okay? There are 91 of you. Is it okay? Our YouTube, right? There's a thumbs up. Is it okay? You just help us do a thumbs up first before I continue. Yeah. So some of you very cheapskate, huh? Some of you, like, sometimes I see like 100 people watching, right? Then I say, hey, I need a thumbs up. Then I realize there are only 50, huh? The other 50 purposely don't press. If you don't mind, quickly press the thumbs up so that I know you are supporting us, that kind of thing. Okay, so let's get started. Let's come back to here, right? So this is a brief idea, and today we are introducing one more instrument so that you have a variety of buffet to decide what to do. And today we are talking about this instrument called Treasury Bill. Treasury Bill, and sometimes the short form is called T-Bill. T stands for Treasury. Treasury, huh? Now, before I start, let me just read some portion of disclaimer. I read this all the time. So remember today, yesterday, last week, or whatever, regardless of whatever instrument that we shared, now just to take note, in no event shall VIA or the authors, which is me and Hillary, be liable to any viewers, all of you, like guest party, for damages of any kind arising out of the use of any content shared here tonight. So remember, neither my Kinesis Investments nor VIA nor the authors of today's presentation are operator affiliated with any broker, dealer, or licensed financial advisor. In other words, we are not licensed by MS. We cannot use words like, oh, please buy, and so on. But we are happy to save you time by doing all the research. So remember, right, neither VIA nor myself, Hillary, makes any representation or warranty to the completeness or accuracy of the information in tonight's presentation. Okay, so the disclaimer is done. So what I'm going to do is I'm going to hand over the airtime to Hillary, and as usual, Hillary will do all the tough work. She's going to go deep dive into what we're going to talk about today, which is the Treasury Bills or the T-Bills. Yeah, so Hillary, over to you.
Good evening, everyone. This is Hillary here. So today we'll be sharing more about what is Treasury Bills, one of the bonds that is offered by Money Authority of Singapore, which is we call MAS. So let's jump right in. So first off, another refresher. So what are the bonds that is offered by MAS? So MAS offered 3 types of bond to the individuals and 5 types to institutions, which are groups that help people to invest their money. But as usual, we will only look into individuals. So the first one is Singapore Savings Bonds, which is quite popular among Singaporeans, and SGS Bonds, which we explored in our previous YouTube live, and T-Bills, which we will be exploring today. So first thing is that all of these 3 bonds, they are fully backed by the government, so they have a AAA rating, meaning that they have lower risk of getting default. And also, you are able to earn regular interest from 2 of these bonds. And it's another way that you can diversify your investment portfolio where you earn the regular interest. So today we'll be exploring about T-Bills. So first off, what is a T-Bill? T-Bill is actually a short-term tradable government debt securities that investors buy at a discount. So what does this mean? Later, I'll be showing a pictogram so that you'll be able to understand better. And how long are the bond durations for T-Bills? First thing is that it's for 6 months, a short 6 months, and it is issued twice per month, and then for 1 year, and this is issued quarterly within a year. So these T-bills are having AAA credit rating, and you can buy it with cash, SRS and CPF funds via auction, which you can bid competitively or non-competitively. And to be noted, for T-bills, when you purchase this T-bill, there is no interest rate stated upfront. So you have to make a bidding, then how much is the interest rate is being offered will be released later after the auction has ended. And the minimum investment for T-bills is about $1,000 in a multiples of 1,000. And the maximum is how much are the biddings available within the auction. And of course, the interest income or capital gains are tax exempt for individuals. So right now, how does a T-bill works? So T-bill is actually known as a zero coupon bonds, means that they actually don't pay any interest during the bond, and they actually issued at a discount when purchased. So it means that when you purchase, you already get a discount. Okay, so the interest rate for T-bill is known as a cut-off yield, meaning that the yield is actually an estimated return for the bond. So the cut-off yield is the highest accepted yield of a successful competitive bid. So imagine that during an auction, everyone wants to purchase that thing that is being auctioned, which is the T-bills. So they will name their price in order to get the T-bills. But for T-bills, when you make your bidding, you have to make it in the terms of yield. So how much estimated return that you expected to gain from the T-bill? So you make your bid over the website, especially over the bank branches. And then once you have made your bid, when they release the result of the auction, only then you will know that whether you are being allocated for the T-bills or not and how much is the interest rate. And usually MAS will publish the cut-off yield, which is the highest accepted yield, because anyone can bid the amount that they want, but it is up to MAS to decide how much is the yield that they are willing to accept. So they will publish the possible highest return of the bond. So how does the T-bills work? So first thing is that the investor has some money, either cash, and they decided to purchase a bond. So it's a kind of a refresher on how does a bond works. Then usually when they purchase the bond, they will expect to earn some interest payment from the bond. But when they purchase T-bills, they actually don't receive any interest payment. So how does this actually work? So let's give an example that the investor has a capital of 1,000 and they purchase T-bills, but they are given a special discount. So let's say that the cut-off yield is about 2%. So upfront, there's $20 being discounted. So the investor only pays about $980 for the T-bills. So after 6 months or 1 year later, depends on the type of T-bills that the investor purchased, the government will then repay back the $1,000 to the investor. So in a way that the investor has earned $20 upfront. So this is why that when you purchase T-bills, you don't receive any interest payment, but you actually get it at a discount. So currently, the cut-off yield for September is about 3.32% for the 6-month T-bills. But just recently, I think it's on 13 October where the October was finished auctioned. The latest is 3.77 for 6 months and 3.72 for 1 year. So you can see that actually the cut-off yield has increased for T-bills. Okay, so now after we know what is a T-bill and how does a T-bill work, we'll be curious that, so what are the pros and cons for a T-bill? So it's suitable for people who wanted to put their idle cash for better returns, and it has a shorter tenor compared to SGS bonds. But like SGS bonds, there's no early redemption and there might be penalty imposed for early withdrawal. And it's tradable on secondary market and earn capital gains, and there's no tax exempt for these capital gains and also interest income. But even though it's tradable on the SGX market, it may be challenging to sell if the demand for the T-bills are low. And the price may rise or fall, depends on the market condition of the SGX, and there's no regular interest payment, something to take note of. So now we will compare the rates. So first off, we wanted to know that how much is the inflation currently. So for Singapore's core inflation is about 5.1%. So what is an inflation? An inflation is that, imagine that 10 years ago, we only need to spend $150 to buy this basket of goods or groceries. But then, as years pass by, the inflation slowly rises. So everything has increased prices, like the oil, gas, and also those foods, and also some other products. And right now, imagine 10 years later, for the same basket of goods and also products, you need to spend about $200 to purchase it. So in a way that inflation means that the money purchasing power of ours has actually decreased or eroded. So when inflation increases, it's not a good event or not a good incident for our wallet. So right now, what is the current inflation rate in Singapore? So you can see that based on this chart, there are two numbers. One is the consumer price index and another is a core inflation. So what's the difference between these two? So a consumer price index is also known as a headline inflation. So it measures the price changes between goods and services that are commonly bought. So for Singapore, we actually monitored these 6 product categories. And for core inflation, they also based on CPI, but they exclude volatile product prices. So for here, the volatile product prices are actually private transport and also accommodation. So let's compare between let's compare between July and August of 2022. So electricity and gas and food, services, retail and other goods are under the core inflation. So we see that food actually increased 0.3% and services increases 0.3% compared to July. So in a way that we saw that the August core inflation has actually increases to 5.1%, but the cutoff yield for the T-bills is actually 3.77%. So should the core inflation drops, then maybe T-bill can help us to generate more income for us. But currently the core inflation is at 5.1. So whether can T-bill beat against the core inflation, it's obviously here that it's a bit hard. Okay, so if T-bills cannot fight against it, how about the current fixed deposit rates that was being offered by the banks? So you can see that many people are queuing up just to apply for the fixed deposits. And also, banks are also increasing their savings account. And recently, we also see news that some banks are offering the max interest rate for the savings account. So let's also explore what are the rates for this. So first off, for fixed deposits, we only explore some of the banks that offer the high interest rates. So we compare between the minimum deposit in order to earn the interest rate and also how long you need to put the money with the bank. So the first one is RHB. So you need to deposit about 20K for 24 months to earn 3.2 to 3.4%. Maybank, same minimum deposit and tenor and also earning 3.2. UOB, 3.0 for 15 months. OCBC, 2.9% for 12 months. And DBS is you can deposit from 1,000 to about 19,000 for 18 months to earn 1.7%. Okay, so how about the saving interest rates? So for Stanchart, 4.88 is quite high and also quite close to the core inflation. OCBC, the next second runner-up, and also UOB at 3.6%, DBS 3.5, and CIMB at 2.0. But even though the interest rate offered by the banks are very attractive, but when you look into the terms and conditions for the eligibility, you will notice that there's a lot of rules and regulations that you need to fulfill in order to earn this. Like for example, you need to purchase their investment products, insurance products, credit your salary, and you also maybe spend a certain amount on their credit cards. So to earn these interest rates, there's something you need to do in order to earn it. Okay, so right now we will also compare the other two MAS bonds, which is the SGS bonds and also SSB. So there's T-bills, Singapore Government Securities Bonds, and also Singapore Saving Bonds. So for T-bills, something to take note is that there's no early redemption and the tenor is much shorter compared to the others, but you purchase it at a discount and upfront, and the minimum amount for you to purchase it is about 1,000. So for SGS bonds, it's quite similar to T-bills, but the tenor is much longer, which is 2 to 50 years. But for SGS bonds, you are able to collect interest payments twice per year. And similar to T-bills, the minimum amount is about 1,000. But do take note that the interest rate are actually fixed. Once you purchase the bonds, that is the amount of fixed interest that you will be receiving every year. And for Singapore Saving Bonds, the government actually offered a flexible investment period, means that even though you put money or you invest into the Singapore Saving Bonds, you can redeem it anytime you want. But do take note that the redemption is not immediate. You need to wait about 30 days before you can receive your money. And you can put in the money up to 10 years. And also similar to SGS bonds, you can collect the interest payments twice per year, but the minimum amount is about $500, and there's a maximum amount for SSB, which is about 200K. And the interest rate that is offered, it's step up, means that every year they will increase a bit year by year for until the 10th year. So right now, let's compare the interest rates between these three bonds. So the first for T-bills, the cutoff yield is about 3.77% for 6 months, 3.72 for 1 year. And SGS, the coupon rate is about 1.875 for 30 years, which is the latest offered bonds in October. And for Singapore Savings Bond, this one is an average for the 10 years, so the average return is about 3.21%. So these are the rates between T-bills, SGS bonds, and also SSB. And the difference between the cutoff yield for T-bills and also the coupon rate or average return is that for SGS bonds and also SSB, you are expecting to receive certain amount of interest payment every year. So the coupon rate is actually referring to the interest that you get paid every year. Whereas for T-bills, there's no interest payment, so they immediately tell you upfront that what is the estimate rate of return that you will receive should you purchase the T-bills. So that's why they use the cutoff yield to indicate the interest rate. Okay, so to conclude all, the T-bills are fully backed by the Singapore government, and it has a AAA rating, and the duration is much shorter compared to the other two. But you may need to renew every 6 months or 1 year, depends on the bond that you purchase upon maturity. And whenever you try to renew it, you may not get the same interest rate for the new issuance. So with that, this is what I found out about T-bills, and I hope you have a fruitful session today, and I'll pass back to Cayden. Thank you.
Hi, ladies and gentlemen, welcome back. So just now Hilary have shared with you some details about the T-bills or Treasury bills. So I'm going to slow down here for a short while as Hilary was explaining, I was looking at the slides and so on. So I realized that there are 2 key slides that are very important. I'm just going to pause at this slide. If you want, you can take a screenshot, take a photo of this. So you realize that she has compiled all the info. Yeah, for you versus you trying to go and figure out bank by bank, right? Now there are, if I could summarize today's session, there are 2 categories of places where you can park your cash. Now, remember, right, in this case, in this segment of your portfolio, you want to be able to have a greater flexibility, low volatility, things are more or less very regular, predictable. Yeah, so usually when you want things that are very predictable, such as fixed deposit, all this, you cannot expect it to beat inflation. Yeah, you cannot have 10%. I mean, it's just, something has to go. So if you look at here, right, you will notice that there are 2 subcategories. One is the fixed deposit. One is what Hilary said as the maximum savings interest rate. So I'm going to pause here for a short while. So if you look at the interest rate, obviously the one on the left, right, will be much lesser than one on the right. So if you want higher, then what to do? They have a list of criteria. Okay, huh? So you ask yourself, do you want to park your money, in such a way? Unfortunately, I think there is no one solution that fits all. Yeah. So I think every bank had their own different strokes. You have to see which one is suitable for you. I still remember one of my students was saying that he tried to do the maximum saving interest rate. So he find it very troublesome. There's a lot of requirement, and then ultimately he gave up. He gave up. Yeah. So what he did was he didn't do the maximum savings interest rate. Remember, that's C, right? You may think otherwise. And then what he did was he shifted to the bonds. He find bonds not so troublesome. Not so troublesome, right? Yeah. So pros and cons. Pros and cons. Yeah. So have you taken a screenshot of this? So this is one key slide among all the many slides that Hilary has shared. And then the other one, she also painstakingly put all the MAS instrument, right, that was listed on their website into 3 different columns. And of course, the most important thing are the returns. So if you want, this is the second most important slide that you need to take a screenshot, take a photo of this. We are very happy, you can share with your friends and so on, so that your friends also don't have to go and compile all this work. It's a lot of work. It's a lot of work, right? So the last deep dive, we talked about Singapore Singapore government securities bonds. And in our autopilot tri portfolio workshop, usually conducted on a Saturday, we talk about Singapore saving bonds. So today, Hillary talked about T-bills. Yeah. So please take a screenshot of this. Now, the interesting thing about how T-bills works is T-bills ask you to buy something at a discount. Yeah. So for example, let's say 1,000, and she gave example of 980, something like that. Yeah. So in other words, actually the minimum investment is 1,000, but it's okay, I give a discount, right? Which is 980. You buy it now, so you buy at 980. And then when the tenor ends, which is either 6 months or 1 year, right? Instead of returning you 980, they return you 1,000. Yeah. So you make that $20, $20, right? Yeah. Okay. So that $20 is like a so-called interest, except that they don't use the word coupon. It's just a different labeling. Yeah, so that $20 return, they call it a cut-off yield. Wow, tomorrow you go back to work, no, next Monday you go back to work and you communicate with your colleagues, a cut-off yield. Wow, you become highly sophisticated, right? Yeah, so actually it's a discount. Okay, So now it's from 980 to 1,000. Oh, you know, the so-called gain, right? It's 3.77 or 3.72. Yeah. Okay, So this one is Singapore government security bonds 1.875. This one is higher. Now, out of these three, I'm just using myself as an illustration, right? Out of these three, if I want to choose, most likely I will choose the Singapore saving bonds. Yeah, maybe it's a bit biased because I'm quite familiar with this. Yeah, it's quite familiar with this. Except that for Singapore saving bonds, that doesn't mean that you got 200K, right? Government owe you, I must give you. Don't have. So sometimes when there's a lot of application, you're also subject to some form of bidding. Yeah, if you hang, right, you hang, right? You're lucky you get it. If you don't, you don't. Okay, but banks is, if you satisfy the requirement, they will give it to you. Yeah, so, you know, nothing is perfect. Yeah, just take a screenshot of this. Like I say, I'm personally a bit biased out of the three. If I choose, most likely I'll choose Singapore saving bonds. Now, bearing in mind that Singapore saving bonds is a step-up interest, so which means that even though here it shows 3.21, the very first year it could be 2.9, then 2.95, then 3, 3.05, and so on. Yeah, so of course to tempt you to keep it as long as you can, so that from the first year until the last year, pro average is 3.21%. Yeah, okay, good. So Wendy has posted some information from CPF board, CPF members below continue to earn interest rate up to 3.5% per annum on their money. Maybe Hillary can check, right? Yeah, okay, good. So have you taken a screenshot of this? Okay, done, Now I'm going to show you one picture, right? Yeah, which is taken within our VIA Singapore Closed Group. This is purely exclusive for our value investing program graduate. You can see one of our good friend, Kelvin Tan. You know, Kelvin Tan, very interested in T-bills. He said, congratulations to those who applied for T-bills. All got allocated for those who select the non-competitive bid. Yeah, okay, So you can see, allocated 100%. All got it. Got it, So, even within our investing community, even we talk about stocks, there's some people who are also interested in T-bills because they can allocate a portion of the cash to one of these instruments. Yeah. Okay, got it, So let's consolidate again. In the very beginning, I said job, cash flow comes. Under Singapore law, no choice. Your employee CPF has to go to CPF, right? And then just now, remember, I asked you to take a screenshot of the table where it shows different bank's interest rate. So, of course, the left side is more of a fixed deposits. The right side are those with a lot of requirements, 100K, 50K, whatever requirement. So it's from 0.05 to 4.88. This is a consolidation, right? And then, of course, you talk about the SGS bonds and then the Singapore saving bond. So I just stuck two, no space for my slide. And it can range from like 1.8 right to 3.21. Yeah, so you can see here higher, but more things. Here slightly lower, but not much requirement. So it's a bidding process. And just like Hillary talked about the Treasury bill, and then for the October's one, right, it's about 3.72 to 3.77. So I think the T-bills and this Singapore saving bonds is quite competitive. So Kin Heng say for T-bill competitive, if we bid say by the eventual rates, does it mean that we will not be allowed to allocate the T-bill? This one maybe I let Hillary reply. Yeah, so that's one. Okay, so remember, right, whatever picture that is being shown here are purely for cash allocation. So for example, if I draw a circle, right? If I draw a circle, And then in our 4 days value investing program, we said we allocate about 25% to cash. Yeah, so this cash you can put into the banks, into these SGS bonds, and into these T-bills. Yeah, and this takes up about 25%. Yeah, you want something very liquid, huh? Yeah, least volatile. When you want it, you get it something back, huh? Then, of course, you cannot expect this to be inflation because it's not meant to be inflation because you want high liquidity, yeah? So you cannot, you complain why it cannot be inflation. It's meant to be like this. Okay, it's meant to be like this, right? But if your objective is to beat inflation, then the bank's interest is not going to work. Whatever bonds that we talk about, it's not going to work. Okay, because that serves a different purpose. Then you have to look for other instrument, right? So I think for many years, I lost count how many years. For many years, I always talk about another instrument, yeah, that is located at this segment. And this segment, right, what is it? Okay, but before I carry on, right, let me show you another picture. In our previous deep dive, I've used the same slides. So ultimately, we have to ask what kind of life do we want. So if you want to see a Switzerland mountain over here, right, then you cannot put in bonds. Yeah, that means you cannot put all your money into Singapore saving bonds. It's not going to work. So you have to have some form of a asset allocation, right? So if your lifestyle is to look at the Switzerland mountain, yes, 25% go to some form of bonds, fixed interest or whatever, but other segment of your portfolio has to go to somewhere that beats inflation. And this is my favorite slide. I've been reusing this slide, I think, for the past 10 years. So Warren Buffett's recommendation, right, is out of whatever money that you have, he even suggested to his wife, right, that 90% of her money need to be put in a very low cost S&P 500 index fund. It's a very low sentence. So in short, if I take Buffett's recommendation and if I slot inside this diagram, right, this is the extra one. Okay, this is the extra one. Yeah, so a low cost S&P 500 index fund. And when I Google, right, there are 3 ticker symbol, the short form, which satisfy this low cost S&P 500 index fund. SPY is not a low cost. SPY is an S&P 500 index fund, but it's not a low cost S&P 500 index fund. So there are only 3 low cost S&P 500 index fund as of today, right? One is offered by Vanguard. Yeah, the ticker symbol is called VOO. You can always Google VOO, right? ETF, exchange traded funds. So this is the first one. The next one you can Google, right, which is IVV. Yeah, you just Google IVV ETF. Okay. Then the third one is SPLG. Yeah, out of these 3, the one with the so-called, I think it's a $40+ is SPLG. That means it's cheaper to buy. For those people with, let's say, 1 month, $100, $200, yeah, it's easier to buy. Yeah, so remember, the CPF, banks, bonds, Treasury Bill all serve certain purpose, but their purpose is not to beat inflation, is to reduce the impact of inflation on you. So out of 5%, maybe you can cover up to 3%. Yeah, but the other sum of money you have to put somewhere to beat inflation. Otherwise, unlikely we're going to make it, right? Yeah. So of course, right now the question is, if you look at this diagram, you can see all the range of instrument, right? Yeah, for cash, you have something that talks about a S&P 500, which is recommended by Buffett. So of course, our question is, if we do not want to work until the Singapore's official retirement age of 63, we have to answer this question. Ultimately, do we want to achieve more than 10%? Yeah, it's either yes or no. If you say no, then you can stop here. You can go and sleep already. But of course, if your intention is you want to achieve more, then there is no other way out. Then the cash portion, let me redraw this, right? Cash portion, you check off. You use whatever instruments, bonds, banks, deposit, you check off already. So you've done something, right? And the other one, ETF, let's say you follow Buffett's recommendation. Okay, then you also check off. So this one you check off, this one check off. Then there's no other choice. There's one more segment left, right? And here it has to target more than 10%. Yeah, otherwise it doesn't make any sense. But remember, right, if you want more, we have to learn more, because there's no such thing as you want more money and then know nothing, right? Yeah. So let me just give you an example. Yeah. So since banks are the one that offer financial instruments and all the deposit, savings rate and so on, right? Yeah. Since banks are offering all this series of instruments to the majority, then some people may be thinking, why don't I own the bank? Since bank offer this, right? Why do I own the bank? Yeah. So this is the price charge of DBS. Yeah, I'm a value investor, so usually I don't look at price, but I need to show you this first. Huh? Now, let's say you are really an intelligent investor. Yeah, you know what's the economic more, DBS, you know all the financial terms, EPS, cash flow, ROE, ROA. Let's say you're super proficient, right? Yeah, and then you bought it. You bought DBS, let's say, on the 15th of July 2007. Yeah, you bought it at the peak. Yeah, bought it at peak. And then after that, you also sell at the peak. Okay, so which is 11 Feb 37.25. So if you look at these two peak, you buy peak, sell peak, right? Yeah, over a span of about 5 years. 5 years. Now, then the ROI is about, careful if you buy T-bills for 6 months, you see, yeah, very good. So you see, like for example, before I continue, SG Boy Wonder, right? Yeah, it's good for this discussion, you know. Yeah, so carry on, right? So for example, let's say if you invest in DBS, you really hold. You're not a trader, right? Buy today, sell tomorrow. So you hold and then you get 9.28%. So that is the capital gain. And then plus the dividend on average, plus minus, right? Let's say 3%, you will have a return of 12.28. Okay? So if you have this portfolio, right? Remember just now we talked about cash, whatever bonds, you know, T-bills, whatever. And then your ETFs, S&P 500, yeah, track record of about 10% since 1965. Yeah. Then here, let's say you buy DBS. Yeah. Then you have a 12%. So not bad, 12%. 12% can beat inflation, can beat S&P 500. Yeah, but we have to be very careful here, like SG, a boy wonder. So sometimes things are not so easy, right? Now I'm using one illustration that you buy a peak, sell and peak. But I can tell you most of the people are not so lucky. Yeah. Even with DBS Bank, right, you can still lose money. Let me give you an example how anyone can lose money, right? Even on companies like DBS. Okay, Now, in order for us to invest, there are a few questions we need to ask. Now, for example, if somebody, right, bought at 15th of June 2007, then after that, remember here's the economic financial crisis, right? So the share price dropped. Then for some reason, somebody, right, they lose faith in DBS. And then remember during the financial crisis, the DBS sell this ridiculous product called the DBS notes, which is a highly sophisticated product that involved the Lehman Brothers, some form of securities. Yeah, so eventually when they lose money, I think they gonna sue. Yeah, gonna sue. And then the relationship managers sell a lot of such DBS bank notes to those seniors. So they lose all the money. Yeah. So let's say you lose faith, and then you sell here. You sell at $7. Yeah. So you buy at 23, sell at $7. So what does it mean? You can still lose 69%. Okay. On a local bank that unlikely will go bankrupt. Yep. So what do I want to show you here, right? Now, I just want to show you here that people can lose money even on a company that unlikely will go bankrupt. And the reason why they can lose money is because of a few reasons. Number one, number one, right? In order for you not to lose money, you must know. There's no other way out. You must know what to buy. And let's say you know how to buy DBS. Seniors also, buy DBS. But the next thing, that's most important thing is you also must know, right, when to buy. Yeah, because if you buy here, sell here, also die. Then let's say if you buy here, like you buy at the peak. I mean, in the first place, why do you buy at the peak? But let's say you buy at the peak, right? And then you got holding power. You hold many years, You see from here to here, right? It takes many years to break even. So in other words, you hold, you buy it, you must also know when to sell, right? Because for so many years, 4-5 years, the share price never go up to the high price that you bought. So you have to endure, right, until this point. Yeah. So in order for us not to buy bank instrument, in order for us not to buy S&P 500, you have no other choice. You must learn what to buy, when to buy, and when to sell. Yeah, so it's not so easy, It requires additional layer of knowledge, right? But of course, the next question is assuming that you are able to do this. You know 1, 2, and 3. So what's your benefit? What's the benefit, right? So what I'm going to do is I'll need my colleague in the next couple of seconds to play a very short video. I just give you a context of this video. The context is Wendy. Like most people, of course, they may know some form of knowledge about bonds, S&P 500, and so on. But she has been working for 30 years. I don't think she wanted to retire at 63. When I met her, she was mid-50s. Yeah, she wanted to retire as quickly as she can. But fortunately, she has worked for 30 years. She has some savings. So she decided to gain the knowledge about these three, what to buy, when to buy and when to sell. So about 12 months later, right, let me share with you the kind of returns that she get. Not only did she beat inflation, in fact, after gaining this knowledge, she retired in 8 months. 8 months. How much does she make? Now I'll let my colleague play the video about Wendy.
Hi, I'm Wendy. I graduated from VIA batch 32. Previously, I was an admin manager, okay, and now I am retired. Okay, I'm financially free now. In the past, actually, I do buy and sell of stock, mainly in Singapore stock, without or little knowledge of the company that I traded. I was actually basically doing just trading or speculation, and the result wasn't that good. Cayden appears to be very sincere in sharing the knowledge. Besides the basic content on investing, he brought up this option strategy, which really impressed me. Okay. I find that it's workable the way he has made. The analogy of collecting premium, just like an insurance company, really attracted me, I should say. So I was very keen and decided to go for it. I became more aware of the risks and rewards on investment. Okay, it really changed my mindset from a trader to become to be an investor. So I must do the due diligence, to evaluate and assess the qualitative and quantitative part of the company. Actually, I didn't really put that much. I was staggering. Okay, the amount that I staggered, I don't one time put all. So until at one time I was thinking I cannot just put in money, I have to set a limit. First 3 to 4 months, I make 40%. In fact, I made the 100K in 8 months. After joining the class, I tried the option strategy. I started with 1 month. Okay, then subsequently, I also go for weekly. I wanted to increase my profit, so I put in more. With the profit that I make, I sort of like compound it. Okay, I go and sell some more option. With the intrinsic value that I work out, I give myself a bigger margin of safety, about 40 to 50. I check the chart, okay, and look at the price level. And also the volume. So when it's at the oversold stage, I sell the option at the price 30 to 40%, 40 to 50% lower than the actual price. To tell the truth, yes, it's definitely more than what I earn, per month. I was very happy when I noticed that I'm able to make that much amount every month. I was thinking maybe I should consider to retire early and concentrate on this value investing. At least I have a lot of free time for myself. Okay, because for the past 25 years, I mean the time is been tied up in the company. So a lot of things I couldn't do. So now that I have a lot of free time, I was thinking to spend more time with my mom. I love to travel around if I can, right? And at the same time to do I was thinking to do some charity work. I think you have to follow the proven strategy that was taught by Cayden. Okay, so you do not panic when the price is down, because you know that you have done your homework. Next, you have to continuously improve your skill. Okay, by attending the gathering class or investment seminar, to remind yourself of the theory and concept of investing. Yeah. So with increasing experience, I believe you can be successful too.
Ladies and gentlemen, welcome back. Now, just to let you know that, just now when Wendy's video was playing, I just had a short chat with Hillary. It's just for me. I was just saying, wow, you do this a bit troublesome for the T-bills. What bidding, then the yield, not so sure, very troublesome. And then on a side note, actually outside this recording, I was just sharing with Hillary. Actually, for us as investors, we just need to sell the options. So usually every month options we can collect about maybe 1+%, depending on the underlying securities. So for me, I don't have to go and bid. I don't have to live with the uncertainty. So like Wendy, right? Yeah, she talked about the options. Options we don't trade. Yeah, we don't trade options. We don't do things like misrepresent option trading as option investing, right? We only strictly sell options, and Warren Buffett only sells options. He doesn't do any other things. Yeah, so just to give you so-called a rough return, right, as an illustration. So every month, I think about 1 to 1.5 on average is quite realistic. Yeah, so this is what we get every month. Yeah, every month. But remember, right, this is on securities. Yeah, securities. We're not fixed deposit and so on. Yeah, so we are at a slightly different category. We're slightly more sophisticated, right? But of course, in order for you to get something like what myself and Wendy is getting, 1 month, let's say 1.5 on average, there's no other way out. Yeah, you don't have to worry about T-bills or this. T-bills to me a bit too little. Yeah. So there's no other way out. So, but anyway, for me, I really spent the past 26 years trying to get more than 10%. So let me just share with you what's in for you, right? Now, other than today's session and all other sessions that we have done, I think we felt that it's important for us to share some so-called protected investment, especially by our government. But if you wanted more, there's no other way out but to learn more. So just to let you know that in upcoming, right, on the 20th of October and the 1st of November, and I'll just need my colleague to post the two links, right? We are running an on-site masterclass, on-site, not a Zoom, on-site masterclass. So you have to physically appear on office, and the reason why you want to physically appear in office so that we can have some form of interaction, I know you and so on, right? On the 20th of October, which is a Thursday, and 1st of November, which is a Tuesday. So the class will start at about 7:15 p.m. and ends about 10. So you realize that today's session is quite short, right? Quite short, it's just about an hour. So this is about 3 hours. And then what are the 3 things that you're going to learn? Here we only focus on things that are more than 10%. For example, right, you will learn how to generate 3 sources of passive income. And remember, when we talk about 3 sources of income, we are talking about more than 10% per year. Yeah, that's our dream, that's our goal, right? Even if you know absolutely nothing about investing. So for today, I think roughly you know what are things that we can do for you. And then the second thing is you learn how to invest in minimal capital. And I say define minimal capital as in every month $100. $100, like bigger or equals to Sing dollars, $100. Yep. And the last one is what Wendy was saying. So literally, we are just modeling after Warren Buffett shamelessly, right? Where we can literally print cash on a weekly basis, or on a monthly basis. The ROI range, excluding capital gain, excluding dividends, so every month roughly, right, is about 1% to about 1.5. So 1 year, more than 12% is quite highly sustainable and possible. Yep. So these are the 3 things that we will do. Yep. So the 2 links are already provided in the chat box. If you are not our graduate, you're seeing this for the first time, or you have heard this, but you're sitting on the fence, the 2 link is there. It's a no-lose situation. Just click on the link. Register is highly complimentary. Yeah, and there's no gimmick and so on, right? Register in the next 1 minute. Just key in your name, mobile phone, email address. And next week on Monday, when my staff come back to work, right, they will reach out to you, tell you all the details, where to come and so on. Yeah. So let me share with you what you will do. So once you register and you appear on site, right, upon registration, that means you come here to check in, right? We are going to give you a hard copy of a manual on how you can invest in the index fund that's recommended by Buffett on autopilot. Okay, autopilot. Yeah, minimum Sing dollars, $100 on a gyro, right, per month. There is 0 transaction fee, right? 0 fee. I just write 0 fee. We're going to give you a hard manual, hard copy manual on how you can open an account, select the right fund, and then get this started maybe in the next couple of weeks. Yeah, and at least based on the past, right? Yeah, this S&P 500 has been delivering an annualized return of about 10.5% with dividends reinvested, yep, since 1965. Okay, so we're going to give you a hard copy. Yeah, hard copy. So that's not all, you know. So you register, we give hard copy, and then you attend the lesson in which I share the three things, right? These three things, right? And then at the end of the session, we're going to give you a hard copy of our national bestseller titled Invest La. Yep, and it's retail at Kinokuniya at $33. So we're going to give you a hard copy, not ebook. And since you invested time, we want to treat you like, how should I say, right? That you feel like you're investing. So because you put in time, which is priceless, not only we give you the book, we are also giving you a Starbucks card, gift card with a stored value of $10. So in other words, we actually give Starbucks $10 for us to give us the card. So we're going to pass this to you. So this and this alone, right, is already $43. Not only that, right, if you bring your friend, one friend or two friends, your friend will get what you get. Okay, yeah. In the process, nobody get harm. Okay, And then if you really bring your friend will get what you get, right? And since you make an effort to bring your friend, yeah, your grocery, right, NTUC is on us. We will also pass you a $20 worth of NTUC voucher, and we not only Starbucks is on us, not only your grocery is on us, your next movie is also on us. So we are also going to pass you a $20 movie ticket. Yeah, but provided you bring your friend, your friend will get what you get, which is the book and the gift card. Yeah, but you, right, you alone, you get additional this NTUC as well as the Starbucks, movie voucher. And the reason why we are doing this for branding purpose, we are a small firm, right? We are not like McDonald's or Starbucks. So we want people to know more about us so that there is some form of word of mouth. And just to let you know that months ago, we are charging $8 per ticket, right? But if you register today, using the link that you shared, it all be waived. Yeah. With that, yeah, so it's $43 of really physical stuff, which is the book and the Starbucks gift card plus the priceless training. So ultimately, you ask yourself, what kind of lifestyle do we really want? Whether you want to stay at the Mount Faber, right, or do you want to stay at the Switzerland mountain? Yeah. So remember, for the complimentary value investing masterclass on the 20th of October and 1st of November, these are three things that you're going to get. Yeah. These are things that you're going to learn. And just now I already shared all the stuff, right, that we're going to give you, which is, something that we really take out of our own resources, and we want to benefit you for our own branding. Yeah. So with that, I wish all of you a good weekend ahead. So fortunately, this weekend I'm not working, so yay, I can rest and spend time with my family. And the links are already there. In case you are not our graduate, you can just click on the link, register, and then I shall see you. And for those people who are our graduate, yeah, please bring your friends, please bring your friends, right? Yeah, so I think what I'm going to do is I'm just going to ask my colleague to put a 5 minutes timer over there. So 5 minutes, you can register, because after the 5 minutes, when we end our so-called YouTube live, right, the link will disappear. It's a YouTube thing, right? Yeah, so if there are any question, please feel free to post it in the chat box, specifically to the T-bills, because Hillary is still here. Yeah, and then just now I briefly mentioned about the S&P 500, right? Yeah. So if any question, you can post it there. Otherwise, the timer will start. I think the timer has already started, right? Yeah. So 5 minutes, we will knock off for the day, and then all of us would have a good weekend. Yeah. So in the meanwhile, maybe I just scroll through in case I miss out any question. Wendy say, thanks VIA for clarifying. So Wendy, if I'm not wrong, Wendy should be our graduate, This Nancy Pass, I think it's the first time that I saw this name, right? So I'm not very sure, is this person our grad HL? So first time I'm seeing this. SG Boy Wonder, thanks for sharing, right? Yeah, he highlighted some things very important. Kin Heng should be our grad. I think the only thing is a Nancy Pass, I'm not so familiar, right? Yeah, so Wendy, you rest well, it's also, how should I say, I chit-chat with you for next few minutes. Right now it's October. How many months left? October, November, December. So right now we're actually moving, for all companies, we are moving to Q4, last quarter. So usually for events, it's slowed down. Right now the economy is opened up, people are traveling, and it's quite hard to run any events on the year end and then expect people to come. Yeah. everybody is all, yeah, okay, yeah. So there's one question, I think, by Zen Relax, right? Zen Relax, new music. Can those that come before physically come again? Zen, I think it all depends on what's your intention, because I'm going to repeat the same thing that I've shared, right? Yeah, so it depends on what's your intention. I mean, if you don't mind come in and sit in, you can always register, but you're going to hear the same thing again. Yeah, so that's more of your time. So you see whether you want to invest the 3 hours again and listening to me again. Yeah. Yeah. So Wendy say thanks for this session on T-bills. Yeah. So maybe what I'll do is I'll go back to that 2 picture, right? While the timer is clicking, and then at the same time, for those people who have not registered for masterclass, maybe I just need my teammate to post the 3 links again, right? I'll just show you for today, there are 2 slides that are very important, while my colleague posts the registration link again, right? Yeah, let me just go back. Yeah, the first one that I felt important is this summary of the bank's interest rate, the left side fixed and the right side maximum saving interest rates. Yeah, but there's a catch. Bank always want to, they want your money, they want to lock you in, put some requirement and so on. So this is the bank. The second most important slide, right, is what Hillary was saying about the T-bills, SGS Bonds, Singapore saving bonds. Yeah, so I leave this here for a few seconds for you to take a screenshot. Yeah, and just now I was saying that, I mean, if I need to choose, but remember, it's just me, right? I don't represent everybody. Yeah, then most likely I'll take Singapore saving bonds. But remember, sometimes you want doesn't mean that you have it. Yeah, but I will aim to have Singapore saving bonds as part of my portfolio under the cash part. ETFs, I think I would trust Buffett. S&P 500, I did a lot of research. Yeah, it's really a good security. Good security. In my opinion, right, it's not a recommendation. It's just how I feel, right? Yeah, so our cash, bonds will be there, some liquid cash, ETF, S&P 500. And then because I'm an investor, I just had to buy something more than 10. Yeah, otherwise I have to work forever, right? So, yeah, then, 26 years ago, I was exposed to value investing, fortunately. Fortunately. So I embarked on this journey. Took me 26 years. So, yeah, so this diagram also quite important. Yeah, this diagram also an interesting diagram. I put it very graphic, right? Yeah, so you have to decide where you want to allocate your cash. Yeah. Okay, so the link is already there. Yeah, 30 seconds, right? So the 2 links are already there. Make sure, in case you cannot see a link, you just need to refresh your browser, right? Refresh your browser. Then you look at the chat again, you should see 2 events, bright link. You just need to click on it, fill up your name, very easy one, 10 seconds you finish. Your name, select the date, select the date, right? Name, mobile phone, so that we can remind you, email address, and then that's it. Yeah, that's it, Yeah, then, like I say, right, if you do not know what to do, even buying DBS also can lose money, because you may buy high, sell low. So it's important for all of us to know what to buy and when to buy. Okay, so the 2 links are already there. These are the 3 things that you're going to learn. Yeah, and these are things that we're going to give you in summary. I think the time should more or less be up already, Okay, got it? Any other final things that you want to ask? There are about 54 of you. Okay, if not, I think the next time that we should see you should be what, like 1 week later? 2 weeks? Yeah, 27th of October. Yeah, we haven't figured out what to do, but we'll think of something that is useful. So remember, right now you're watching this YouTube deep dive series delivered by VIA, and VIA stands for Value Investing Academy, and our mission is we care to make all of you a better investor. So with that, have a good weekend, have a good rest, stay safe, and I hope to see you, right, in one of our masterclass very, very soon. So goodbye. Thank you all.